Thanks for joining us on Power Lunch. This is BloombergQuint and I'm Meera Dugal. Let's get you the headlines. The Nifty and Sensex hold on to morning gains. Broader markets too rally in line with the benchmarks. Adani Gas shares surge after French giant Total agrees to buy 37.4% stake in the company for $600 million. The NCLAT stays the sale of Bhushan Power to JSW Steel under the insolvency process, puts the 19,700 crore payment on hold. Hindustan Unilever will be the only Nifty company reporting earnings today. The FMCG major is expected to report wider margins. And wholesale price inflation eased 0.33% in September, the lowest since June of 2016. Consumer price inflation expected at 3.8% according to a Bloomberg survey. Right, let's first take a look at how markets are faring. Darshan is here with us.
Yeah, it's decent at this point of time. The Nifty's managed to surge 60 points. The Bank Nifty has done well, up close to 300 points. So that is doing well. And that is mid-caps and small caps also. Not the best performance, but it's the benchmark indices that have done well in trade today. The real estate index is the one that's leading the rally. It's up almost 2.7%. After that comes the metal index, which has done well post all the news that has come in on the China-US deal. The high beta counters have done well today. Counters like a PC Jewelers, DLF, Adani Enterprises, Container Corp, all these counters have managed to move in trade. Birlasoft won a big order today. So that is the one that has managed to do well. Among the losers, Infosys post the numbers has reacted negatively. It's down almost 4% in trade. So that's one of the few large caps which are down in trade. Adani Gas, obviously we spoke about the big infusion that happened in the company. That's up 12%. And Fine Organics is the other one which has managed to rally 10%. But overall, market momentum seems to be on the positive side.
Darshan, thanks so much for that. French energy giant Total is going to buy stake in Adani Gas. The two companies will also form a joint venture to market liquefied natural gas in India and Bangladesh. Somit Sarkar standing by with the details. Somit.
So Total is aiming to hold nearly 37.4% stake in the company, for which firstly it will make an open offer for the public shareholders. Now the public shareholding in the company is close to 25.2%, and for that it will make an open offer at around 150 rupees per share. Now this 150 rupees per share pricing was at a premium of 8% to Friday's closing. However, after this up move around 12% that we are seeing currently, it is at a discount of nearly 4-5%. Now Adani, after this open offer, the shortfall in the 37.4% holding will be sold by Adani Gas promoters, that is Adani Group promoters, to Total. So in short, after this entire deal of the open offer and the stake sale by the Adani Group, Total will hold close to 37.4% stake in Adani Gas, while the remaining 37.4% will be held by the Adani Group promoters, and the remaining around 25.2% by the public shareholders. Now, what will this give to Total? Well, Total will get an entry in the city gas distribution space in India via this investment in Adani Gas. So Adani Gas has access of around 38 geographical areas, and it's also planning to set up retail fuel outputs or retail fuel units which will supply gas and in future could also supply petrol and diesel.
Thanks so much for that, Somit. Adani Group CFO Rabi Singh says the deal will help address procurement for Adani Gas, which is primarily a distribution and retail city gas player right now.
So the investment plan does not change because of this transaction. That we are committed to the Adani Gas.
It intensifies, right?
It effectively, what it does is it solidifies certain aspects of the transaction. So Adani Gas is primarily a distribution and retail business. And then we have another, previously announced, another joint venture with Total on LNG and terminals. Now, if you look at both as a portfolio, then this becomes an integrated gas utility, from procuring gas all the way to distribution to the final customer. Okay, so from numbers perspective, Adani Gas is committed to its plan, which is approximately 7,000 crore, which will happen over the next 10 years. Now, that plan continues. What it does for Adani Gas is that gives them access and ability via Total to better manage a procurement plan, because then Total being the largest, one of the global majors, it now gives us access to procurement on a very competitive basis.
The National Company Law Appellate Tribunal has put a stay on JSW Steel taking over Bhushan Steel and Power. The order comes in about a month after the Delhi NCLT finally gave the country's largest steel maker the permission to buy Bhushan Steel and Power. The NCLT has also stayed the enforcement director's move to attach Bhushan's properties. Upamanyu Trivedi of Bloomberg News joins us on the phone line with more details. Upamanyu.
Yeah, that's correct. It comes as a setback to banks in its recovery efforts because this will delay the payment for sale of Bhushan Power to JSW. And the tribunal also took very strong objection and passed some strong comments on enforcement directorate seizing the assets just 2 days before the hearing was scheduled in the tribunal. That said that such actions by law enforcement agencies might make the whole insolvency and bankruptcy code redundant and would harm the economy, as no one will come to invest if such actions are taken. So the tribunal has directed immediate release of assets of Bhushan Power, and meanwhile it has also stayed the payment that JSW was supposed to make for Bhushan Power, because observing that if eventually the enforcement directorate wins the case then and takes the assets and sells them, then what would JSW be paying for? So the setback has come for banks, and the next date for hearing in which they will decide whether enforcement directorate has jurisdiction to seize such assets which are under corporate insolvency process or not is October 25th.
Upamanyu, thanks so much for that. Two of the country's largest IT firms have now reported their second quarter numbers. The common theme for both is the growth witnessed in digital services, but Infosys seems to have an edge over TCS this time around. Agam?
Right. So, well, it certainly is a quarter where Infosys has outperformed its rival TCS. But let me take you through the numbers very quickly. And to start off with revenue growth on a year-on-year basis, we're looking at 11.5% and in line with consensus expectations, whereas TCS looking at a year-on-year growth of around 8.5% is below street expectations. So in this case, clearly Infosys is the winner. But to take this aspect forward, even in terms of operating margins, sure, both the companies have seen contraction year on year, but Infosys' contraction is a tad lower or a tad less than that we've seen in case of TCS. Moving on to, well, the other aspects in terms of digital services revenues, again, while both companies have seen a considerable surge in and growth in their digital businesses, well, TCS standing at around 28%, which is robust, but Infosys also at 38%, and this is considerably better than TCS in terms of growth. Also that 38% of the consolidated revenues for Infosys now come from the digital businesses. Moving on to financial services sector, again, double-digit growth for Infosys as compared to just 8% growth for TCS, and that volatility in markets abroad has been playing well against TCS as far as growth there is concerned. But finally, moving down to your outlook, Infosys has hiked the lower end of the guidance from 8.5% to 9%. Of course, the top end remains at 10%, which is the same, but that has come in with a little bit of disappointment as far as some of the analysts are concerned, because they were expecting, well, a higher upward revision as far as the top end is concerned. But TCS, on the other hand, is, well, actually currently ruling out a very high chance or a very high probability of double-digit growth. So this clearly works, in favor of Infosys again. In terms of margins too, we're looking at Infosys coming out and well within its guided range of around 21 to 23%. On the other hand, TCS, well, looking at that aspirational number of 26 to 28%, which does look elusive at this point in time, considering its margins are somewhere around 24%. So on the whole, it certainly is a quarter in which Infosys has fared much better with TCS across various variables.
Thanks for that, Agam. Hindustan Unilever may not have pushed up its volumes in the second quarter, but it's likely to have ensured better margins. Agam is still here, and he's telling us what the street's pricing in.
Right. So, we know that there has been a slowdown. That impact has been showing up for a lot of these companies. And of course, HUL is not going to be any different, considering it is India's largest FMCG company right now. So, we are likely to see, in terms of expectations, about no more than a 5 to 6% uptick as far as well, your revenue is concerned. EBITDA is also likely to rise around 8.5%, but it's largely on account of various operational efficiencies. We are keeping an eye on the margins, as I was suggesting. Look, likely to see an expansion there. Profits could rise 17%, but it's not because of growth. It's largely because of advantages playing out because of corporate tax cuts. But moving on, of course, we are keeping an eye on the all-important volumes growth number, which is expected to come in at around 3 to 6%. There could very well be a little more tapering because last quarter, sequentially, we saw 5% volume growth, and before that was 7%. So we're going to have to wait and watch. There has been high inventory in channels, which is kept growth, I would say capped to a certain extent, and of course growth is going to be driven by the modern trade channel and around e-commerce as well. Let's move on and talk about gross margins. Of course, they're likely to expand by as much as 140 basis points, and for good reason, because there has been that help from relatively lower or curtailed input costs environment. In terms of what we can watch out for, let's move on and talk about that. We are keeping an eye on outlook in home and personal care, and of course the rural versus urban growth is also something that we are going to keep an eye on. And finally, impact of price changes and perhaps the change in pack sizes and launches on the horizon. But on the whole, we're expecting a quiet quarter from Hindustan Unilever.
Thanks so much for that, Agam. In another sign of economic slowdown, India's industrial output contracted in August. The fall was the steepest since 2012, largely owing to a cutback in manufacturing activity. It also indicates a lack of confidence in the festive season, as it appears companies have not pushed up stock ahead of the festive months. Pallavi Nahata has the details.
The index of industrial production contracted by 1.1% in August, defying expectations that industrial activity would pick up ahead of the festive season. IIP in August was the lowest since 2012. It was lower than the growth of 4.3% in July, and it was also lower than the forecast of 1.7% by a Bloomberg poll of 31 economists. The manufacturing sector continued to contribute to weakness in industrial output. 15 of the 23 manufacturing industry groups showed negative growth, leading to an overall contraction. Manufacturing output contracted by 1.2% in August compared to a growth of 4.2% in the previous month. Mining output was almost flat, and electricity generation contracted by 0.9% in August. Within manufacturing, the motor vehicles, trailers and semi-trailers segment saw a contraction of 23.1%, while industries such as food products, basic metals, wood products and wearing apparel grew by over 10%. When divided by use-based classification, capital goods output contracted by 21% in August against a contraction of 7.1% in the previous month.
Meanwhile, wholesale price inflation eased to 0.33% in September, the lowest since June of 2016. Inflation was kept in check largely because of fuel, power and lighting prices, which fell 7.05%, and manufactured product prices, which fell 0.42%. On the other hand, primary article prices rose 5.54%, and food article inflation was at 7.47%. We're also watching out for the consumer price inflation numbers that come in later this evening, expected at the highest levels in about a year, but well below the 4% mark, which is what the central bank will be tracking. Let's go across to Aditi Nair, Principal Economist at ICRA, for a read on all of these numbers. Aditi, thanks so much for taking the time to speak to us. Let me actually start with the wholesale inflation numbers, which came in, sort of sending the same signal that has been sent by many other indicators, which is that demand conditions are weak, and that, I guess, gets reflected in both headline and manufactured goods inflation.
Thanks, Ira. Definitely, I think demand conditions are weak, so is pricing power. And also, when we look at the global scenario, commodity prices broadly are quite sluggish as well. And that's really impacting the landed prices of imports and keeping an overall slack as far as the WPI inflation is concerned. Here we have two major factors that have pulled down the WPI inflation to 0.3% in September, which is fuel and power and the non-food manufactured products, as you mentioned. Now, interestingly, as far as the non-food manufactured products is concerned, we got month-on-month flat reading. But because of the base effect, we got a very deep disinflation coming in for the core WPI. to 1.1% in September. So overall, either way, the prognosis is really the same in terms of what are the factors that are leading to this weakness. I think it is weak demand and weak commodities and weak pricing power. So overall, not a very good scenario. On the other hand, if you look at food prices, the inflation has barely budged. It's just come down by about 20 bips between August and September, because whatever has been the progress as far as dampening inflation for fruits has been totally offset by higher inflation for vegetables driven by onions. So as far as food inflation is concerned, they're always going to have these temporary upticks, but I would still say that the late withdrawal of the monsoon and the flood-related damage to the standing crops is something that needs to be viewed with caution even in the current quarter.
Okay. Aditi, what would be you expect to see on the CPI side, particularly on some of the urban components which have been rising lately?
So, on the CPI side, I would expect the inflation to rise up to about 3.4 to 3.5%. Tad bit higher could be because of vegetable prices again being a little higher than what we had forecast. But I would still expect it to be well under the 4% mark. Now, going ahead, we do expect this inch up to continue, and main contention from our side is that food inflation is likely to inch up because of various factors, but the core CPI inflation may not fall significantly and is likely to not be in line with what's happening on the core WPI, because the composition of the indices and what drives them is completely different. So we shouldn't expect to see the disinflation in core WPI seeping into core CPI anytime soon. And therefore, we are likely to see mild upticks in the CPI inflation going ahead, bringing it closer to 4% over a period of time. But yes, only close to 4%. We're not expecting it to breach 4% in a significant way going forward, and therefore perhaps there will still be some more space for monetary policy to support what is clearly fairly deeply entrenched and structural growth slowdown.
All right, Aditi, we got the IIP numbers on Friday. What to you was the most surprising of the lot? What stood out?
So, Ira, as far as the IIP is concerned, we were fairly certain that the numbers that we saw in July were going to be a flash in the pan and were not going to repeat themselves in August. We had expected really tepid 0.2% growth in the IIP, so we were a little bit surprised to see the contraction in the IIP, the extent which was there in the August numbers. I think one of the sort of new sources of volatility in the last few months has really been intermediate goods, because we suddenly got this double-digit growth for 3 months, and the growth halved from about 14% to 7% in August. And that's actually one of the biggest reasons for the sequential dip as far as IIP's performance is concerned. So auto, coal, mining, electricity, all of these were well known, but I think what's been a little bit of a surprise is this volatility in intermediate goods that possibly we've not been able to track very well.
All right, Aditi, thanks so much for giving us those perspectives on various data points. Aditi Nayyar of ICRA on the monthly economic data. Meanwhile, the World Bank has cut India's growth forecast in its latest South Asia Economic Focus report. India is projected to grow by 6% in the current financial year, compared with 7.5% forecast in April. That's the sharpest cut among the South Asian nations. The report terms India's cyclical slowdown as being severe, citing a deceleration in demand and the weak financial sector. Growth is expected to gradually recover to 6.9% in FY21 and 7.2% in the following year. The US and China have agreed on a broad outline of a trade deal. While President Trump is hailing the progress, critics say it still leaves some of the key issues unresolved. He earlier tweeted that phase 1 of the deal can be signed as early as next month. Tom McKenzie of Bloomberg News gets us the details.
Well, certainly he's right to say that China has stepped up already purchases of US agricultural products. Whether or not they'll get to the $40 to $50 billion a year, which is almost double what they were buying prior to the trade war, is a big question. But he's right to say that some of those agreements, some of those purchases have started already. And he was stressing that in the tweet, saying that this was immediate. It was going to immediately have an effect on the US farming population. Of course, there's the political incentive for him to stress that part of it. He also in that tweet, by the way, talked about the financial services sector, which China has, of course, said that it's going to open up more quickly than we had expected. That came through on Friday. And also in this deal, this phase one deal, you had an agreement, unspecified agreement by China on the yuan and also on intellectual property. What you didn't get was an enforcement mechanism or any discussion of industrial policy or state subsidies. Take a listen to President Trump talking about what was in and what has yet to be put into this deal.
Intellectual property, a lot of agreement, but we'll have some of that included in phase two. Security companies and certain companies we have to be careful with, and we have to pay very close attention. But we're doing tremendous business with China and with Chinese businesses. It's tailed off. We've tailed it off. We've purposely tailed it off, but that'll start building up very quickly again.
So no agreements on national security, for example, the curbs on Huawei, or of course those 8 companies that China blacklisted over human rights abuses. No agreements in terms of industrial policy or state subsidies, and no enforcement mechanism. But of course, President Trump saying that progress has been made. You're going to sign off on this deal, he hopes, with President Xi in Chile at the APEC summit come November. And then he says you move on to phase 2, where he's hoping, of course, that some of these more complex issues can get ironed out and signed off on as well. But of course, many economists and analysts looking at this are sceptical because it isn't even a deal on paper yet. It still needs to get to that point. It's just a handshake. So, of course, there is that period of time, 3 to 4 weeks before we get the two presidents meeting, where, of course, negotiations could potentially come apart. There will be a hope, of course, that doesn't happen. For now, those threatened additional tariffs come October the 15th will not be imposed, but you still have the threat of tariffs come December the 15th.
All right, that's a wrap on this edition of Parliament. Thanks for watching.